Let's meet George. Every day, George goes out and gathers green leaves. In the jungle economy, those leaves are his income. But George can't keep them all. He immediately has to hand some away to pay for a tiny hut and his daily food. We call those outgoing leaves his expenses. Fortunately, George does get to keep some things of value. His banana phone and his favorite sneakers are items he owns outright. In finance, anything valuable you own is called an asset. But George also has a car loan he hasn't paid off yet. Any debt you owe to someone else is called a liability. This balancing scale shows exactly where George stands. On one side is the total value of his physical assets. On the other, the heavy red weight of his liabilities. Subtracting what he owes from what he owns leaves his final net worth. If your expenses consume all your income, that net worth number will never grow. Mapping out exactly what you own versus what you owe is the required first step to breaking out of the jungle rat race and building actual security. Once you start accumulating valuable assets, you attract attention. In the modern jungle, tech apes and hackers are constantly prowling, trying to spy on or steal your personal digital assets and private data. Proton Drive uses end-to-end encryption to store your files in a way that makes them unreadable to everyone but you. Not hackers, not advertisers, and not even Proton can see what's inside. While secure storage protects what you already have, the way your assets behave over time determines your future wealth. Look at this single yellow banana rotting on a rock. As it turns to mush and loses its value, it is undergoing depreciation. A healthy banana tree, however, naturally grows stronger and produces more fruit every year. That natural increase in value is appreciation. A vault full of rotting fruit will eventually leave you with nothing. To stop working for your food, you have to acquire assets that appreciate. George decides he's tired of foraging for leaves. He finds a successful local banana cart and decides to buy a stake in the business. This diagram illustrates exactly how we calculate what that business is worth. We take the tree's total output of bananas and multiply it by the current price tag of a single leaf. These numbers merge into one massive golden leaf. This total value is the company's market cap. George negotiates a 51% majority stake. That 51% chunk sliding over to his side is his equity. George is no longer a laborer, trading his time directly for a daily pile of leaves. By purchasing a piece of a cash-generating business, he becomes an owner, allowing his wealth to grow while he sleeps. As an owner, George gets special perks. Every few months, the healthy business drops extra bananas that are handed directly to the owners. Those regular bonus payments are called dividends. If George spends 100 leaves to buy a tree and it drops 10 bonus bananas a year, that 10% ratio of fruit to cost is his yield. Years later, another monkey offers to buy George's piece of the cart. If George sells his stake for significantly more leaves than he originally paid, that large lump sum profit is a capital gain. Of course, timing that sale depends on the mood of the jungle. When all the monkeys are optimistic and prices are steadily rising, you are in a bull market. When the monkeys panic and prices are dropping across the board, you are in a bear market. The daily weather of the market will constantly fluctuate between optimism and fear. Securing your future requires ignoring those short-term emotional swings and focusing on long-term capital gains and steady yields. To succeed as an investor, George has to look at the entire jungle. If one giant cart controls all the food and sets whatever price they want, that's a monopoly. If 3 or 4 big carts quietly team up to control the prices together, you're looking at an oligopoly. Sometimes the monkey government decides that food is getting too expensive. They step in and hand out extra leaves to struggling farmers to help them cover costs. That government assistance, designed to keep market prices artificially low, is a subsidy. Eventually, George notices something interesting. Bananas cost only 1 leaf in the southern valley, but they sell for 5 leaves in the northern peaks. He starts buying them cheap in the south and walking them north to sell for a profit. Taking advantage of that exact price difference across different locations is called arbitrage. The wealthiest monkeys don't just work harder. They learn the mechanics of how the jungle operates, spot hidden structural advantages like local price gaps, and use those rules to accelerate their wealth. But patience is difficult, and George wants to get rich faster. He goes to the monkey bank and borrows a massive pile of leaves to buy a huge inventory of bananas all at once. Using borrowed money to multiply your investment size is called leverage. This line chart tracks the danger. Watch the price spike wildly to the top, then instantly crash. Those unpredictable swings are high volatility. The crash triggers an alarm. His broker demands a deposit to cover the debt. That subtraction is a margin call. George has a huge problem. All of his wealth is tied up in a massive pile of bananas that no one currently wants to buy. Because he can't quickly convert his inventory back into leaves, he has low liquidity. Unable to produce the leaves for the margin call, George defaults on his loan. The bank steps in and legally seizes his prized banana car. He had promised the car to the bank as a backup payment, which makes it collateral. Borrowing money allows you to buy more assets and amplify your profits when times are good. But if a volatile market suddenly drops and your money is locked up in items you can't sell, the resulting debt can wipe out everything you own in a single afternoon. George learns a hard lesson. Guessing which way prices will go based purely on your gut feelings is just speculation. True investing relies on methodical risk management. This visual loop breaks down one way to manage that risk. First, you borrow a banana and sell it immediately for a large coin. Later, when the price drops, you use a smaller coin to buy a replacement banana and return it to the lender. You keep the leftover profit. Betting that a price will go down like this is called shorting. An even simpler method is diversification. George starts splitting his money between bananas and coconuts. If a disease hits the banana trees and their value falls, monkeys get hungry and the demand for coconuts naturally goes up. Because one rises exactly when the other falls, they have a negative correlation. Financial masters don't try to predict the future with perfect accuracy. They divide their assets across different, opposing investments, creating a portfolio that protects their net worth even if their primary business takes a hit. To finalize his defenses, George signs a contract locking in the right to sell his future bananas at today's price. If a massive jungle storm wipes out the local economy next month, his savings are protected. Making a secondary investment specifically to guard against a worst-case scenario is a hedge, and the contract itself is a derivative. These concepts provide a way to shift risk, protect wealth from predators, and secure a stable future. Now that you know the mechanics of the jungle, you have the vocabulary to take control of your own assets. Go ahead and use these terms to impress